Welcome back to Crypto Simulation Theory. Tonight's video is going to focus on risk management, part 2, portfolio optimization strategies. Nothing contained in this video is considered financial advice. I'm not a financial advisor. All information is considered to be for educational or entertainment purposes only. So let's get started. So as part of my risk management series, I have a 5-part series. We did the investor mindset in part 1. Portfolio optimization strategies is this one. Understanding market psychology will be next, using risk metrics and profit taking and market exit strategies. Everything you need to be a successful investor. And these are my social links. I'm on Telegram at the Snake Pit, TikTok at the Gaussian Snake, Twitter at the Gaussian Snake. And if you follow me on my Telegram after watching this video, you're going to get exclusive free access to my portfolio management tool. This is only available for a limited time, so join the group, and sometime this month I'll be dropping that tool for you. So let's get started. Just some basics. Whenever it comes to crypto investing, I'd say to only invest a sum of money you're willing to lose without it impacting your lifestyle or mental health significantly. Your position sizing for cryptocurrency should be directly proportional to the net percentage of your overall portfolio that you're willing to lose. I just noticed a typo there, but you know what I mean. Rule number 1, crypto allocation rule. The older you become, if the older you are, the less time you have to make the necessary readjustments. If you were to lose your money and try to gain it back, it would take you, if you're younger, you have a lot more cushion to do that. But when you're older and closer to retirement, you can't really afford to make tremendous mistakes. And so there's a classical rule of investing that it used to be that you would subtract your age from 100 and let that number be the total amount of capital that you would invest in the market, with, of course, a larger portion of that capital being devoted to lower risk stuff such as equities, precious metals, treasury bills, those kinds of things. Now they've raised it to 110, 120 because people's life expectancies are longer. So people who are, it used to be that when you were getting older, you had less time, left to invest because life expectancies were shorter. But in general, life expectancies have gotten longer in many countries, not in all. And so, you can just subtract from 100, 110, or 120, doesn't really matter. Whatever the result is, that generally gives you a percentage. Now, this is just a classical rule. You don't have to follow it. So, how do we know how to best manage our portfolio? What kind of portfolio will give us the optimum results? So, there is a theory known as modern portfolio theory, and it basically operates on this risk curve, which is elliptical risk curve right here. And you have on the x-axis, you have risk or volatility, standard deviations away from the mean, and you have the expected return lower to higher on the y-axis. And so it's not really the line, but this curve represents the efficient frontier, which is the optimal combination of risk and return. Now, there would be an imaginary line here of zero risk assets, but we're not really interested in that. We're interested in making some money. So the idea is that if you're on this curve, and this curve has a formula described by the Sharpe ratio, which I'll show you in the next slide. Basically, what it's saying is that you want to have an optimum portfolio. It consists of a diversified blend of high, medium, and low risk investments, with the main focus being on medium and low risk. And the use of statistical methods reveals that the performance of a single asset is not as relevant as how that particular asset affects the portfolio as a whole. And so low risk investors are encouraged to diversify. Everything's about diversification. Diversify asset class investments to further reduce risk. And portfolios that are on the efficient frontier theoretically have the highest levels of predicted return relative to their risk. So if you're to the right of this, you're going to be taking on more risk for possibly a lower return, and if you're above here, you may be taking on too low of a risk. So you have to kind of manage your expectations. That's what basically this is saying. And if it seems overly simplistic, it is. So there are some criticisms of modern portfolio theory, and one of the major criticisms is it only uses the statistical concepts of variance and standard deviation to quantify risk. It's just completely oversimplified via this Sharpe ratio, which is is a ratio of different kinds of statistical quantities. Let me explain. So R sub A is the asset return. R sub B is the expected, or I'm sorry, is the risk-free return. So like a U.S. Treasury security or something that would basically be nearly zero risk. And you take the difference of these two, and then this E of that difference is the expected value of the excess of the asset return over the benchmark return. And sigma sub A is the standard deviation of the excess asset return. And so this is going to give you a T statistic, and this is going to equal the Sharpe ratio times the square root of T, which is the number of returns used in the calculation. So this basically, to summarize it up, treats all volatility as risk, leaves out the psychology of portfolio construction and individual investor preferences, and it assumes an ideal elliptical curve. If we go back to this slide on the previous page, it assumes this like perfect curve is going to play out in reality, and we know that that's not usually the case. So in 1991, Brian Rahm and Kathleen Ferguson, who were two software engineers, pioneered postmodern portfolio theory. And this introduced the concept of the Sortino ratio as a replacement for the Sharpe ratio from modern portfolio theory. And that Sharpe ratio is a discrete ratio. This is also going to bring in some continuity, which you can see with the integral right here. This is an improper integral for those of you who've taken calculus. So modern portfolio theory determined risk through the use of standard deviation of all returns. Postmodern portfolio theory improves upon this by using the standard deviation of negative returns to reduce risk and minimizing downside risk. So you have the formula R minus T over D, where R is the annualized rate of return, T is the target return, and D is the downside risk, given by this formula, which is the square root of the improper integral from negative infinity to T of T minus R quantity squared F of R dr, where D is the downside deviation, also known as downside risk. D squared would be downside variance. T is the annual target return, the minimum acceptable return. R is a random variable representing the return for the distribution of annual returns. And F of R is the function that describes the distribution for the annual returns. And so this is the Sortino ratio, and it gives you a more dynamic and realistic conceptualization of downside risk incorporated into the Sharpe or the Sortino ratio to give you an idea of your portfolio's efficiency. So there's some other resources for portfolio optimization that go above and beyond these Sharpe and Sortino ratios, and so I'm going to link you to all of these in the video description. Now, keep in mind that there are currently no online tools that I'm aware of that will allow you to calculate the Sharpe ratio or Sortino ratio for any asset. Most of these are designed for equities and other low-risk investments, but you can certainly program your own or go find a crypto YouTuber who has a website that has this stuff on there. But if you have a little bit of programming background, I don't think it would be the most complicated thing to run some of these calculations. But you do also have to ask yourself, is there a point at which you're maybe overanalyzing things, especially with something as highly volatile as crypto? So it's there for you to use if you really want to use it. So I'll put links in the video description. Rule number 2, develop an investing strategy. So you can keep things simple by just taking a fixed amount and just spreading it evenly into like 6 or 7 crypto projects, regardless of the market cap, small to large. Now, do I think that is a great idea? No. But it's simple. It's not going to give you the most efficient returns, generally speaking, but it's a very easy and simple strategy to implement. Or what you could do is you could allocate your investments proportionally according to the total market cap of the crypto you're investing in and proceed with a fixed or dynamic DCA strategy. Easier said than done. Now, the tool that I'm going to give you in my Telegram group is related to that second point. So think of it as like a DCA strategy worksheet, a dynamic DCA strategy worksheet with everything set up nicely for you to be able to figure out how to do that. You may also wish to set stop losses to prevent a catastrophic loss on your position, but if you set a stop loss, you have to be aware it's crypto, things are volatile. You could get a wick to the downside very quickly that wipes out your position and it just jumps right back up. So even setting stop losses is a risk. Now, what are the pros and cons of a DCA versus lump sum approach to investing? Let's talk about that. The pros of a DCA approach is that it averages out price volatility over time. It reduces your emotional investment decisions. It's a very easy strategy for beginning investors to do, and there's no need to time the market. And so my worksheet, the one that you'll get over at Telegram, that will basically help you set up a dynamic DCA approach exactly in that way. It's a great approach for beginning investors and for advanced investors who don't want to try to have to time the market. But there are some cons. This is not a perfect approach, and nobody should tell you, oh, the DCA strategy is the best strategy. Most of the time it probably is, but not always. You are looking at having lower overall returns than somebody who doesn't use the DCA strategy. You're also looking at increase in transaction charges for every single DCA that you do, and you could also end up missing out on rallies because you're doing these like small DCAs, and what if price just shoots right up? You've just missed out on a portion of that rally. So the DCA approach is a great approach, it's just not perfect. What about a lump sum approach? So the pros of a lump sum approach, where you just throw a bunch of money at an asset in the market, is you get a good exposure to total market growth over time, and you only have to make a decision once. Just set it and forget it. And most likely you'll have lower transaction fees because you're just doing one transaction. It's a highly risky, but it could be effective if you get lucky. That's the key part. There's a high risk of mistiming the market. It can be very emotionally taxing. Who has like a large sum of money that they can just want to throw into the market? Affordability. The risk of FOMO, I didn't write that in there, but that could happen because you could end up being overexposed to a particular set of assets, and then some new crypto comes along and you're stuck in the ones that you have and you're having to wait them out. So the lump sum approach is extremely risky, but if you have conviction in it and it's the way you like to approach things, who am I to tell you not to do it? Okay, there's also something called the Kelly criterion, because you may ask a question, so Galaxy and Snake, how many cryptos should I have in my portfolio? How many are too many? Now, for my own personal preference, I like to stick to between 5 and 10. I find that to be my sweet spot. If I go under 5, I'm going to feel under-diversified, and that any one of those cryptos could end up wrecking my portfolio, right? If I have more than 10, I'm going to have trouble keeping track of all those cryptos, right? And if I start to go up to 15, 20, 25, what ends up happening is that the individual benefit of holding any one of those cryptos is outweighed by the sheer over-diversity in your portfolio, and what ends up happening is you start to track the overall market, and you end up reducing the potential gains. So there is a sweet spot. Now, we don't know exactly what that sweet spot is because a lot of it depends on the type of cryptos you're invested in, whether they're micro caps, small caps, mid caps, large caps, Bitcoin or Ethereum. And we also have to consider your entire crypto portfolio in relationship to your equities portfolio and other investments that you might have. So it's not a simple equation. Now, the Kelly criterion was originally developed by John Kelly, who was a researcher at Bell Labs, which later became Pacific Bell, and then I think AT&T after that. You can correct me if my history is wrong on that. Probably is. Well, say that with a lack of conviction, but this was developed in 1956, and it was actually originally used as a way to analyze a telephone engineering problem, so communications engineering. But this ended up being used by some of the top investors, including Warren Buffett, Bill Gross, and the late Charlie Munger. And it's a very simple formula. You have K% equals the difference of W, which is the winning probability, minus 1 minus W, so 1 minus your winning probability, all over your R, which is your win or loss ratio. And that will give you an idea to determine the amount of money that you should put into a particular asset or asset class by looking at data from your past investments and then calculating your portfolio's win-loss ratio. So what you would do is you basically look at your last 50 or 60 trades. You could look at your tax returns. If you I use Coinly for mine. Well, not for my tax returns, but I use it for my crypto tax data. You just basically backtest your trading to see what's working and what isn't, and then you make adjustments as necessary. So you calculate W, the winning probability, by dividing the number of trades that return a positive amount by your total number of trades, both positive and negative. And this number improves as it gets closer to 1, but any number above 0.5 is good. So you want a ratio. You're not going to have a ratio of 1. You're not going to win all the time. But generally speaking, anything over 50% win rate is a really good win rate. And some people might even be might be satisfied in crypto with a 20 or 30% win rate. Ideally, you're winning more than you're losing, though. Okay, so I think 50% or more is a good benchmark. Then you calculate R, which is the win-loss ratio. Just divide the average gain of the positive trades by the average loss of the negative trades. And again, you would have a number greater than 1 if your average gains are greater than your average losses, and a result of less than 1 would tell you that your losses are bigger than your wins, right? So if wins are bigger than losses, you're going to have a ratio bigger than 1, okay? But if the losses are bigger than the wins, you got a bigger number on the denominator than on the numerator, that ratio is going to be going towards 0, and that's not a good situation. So then you put the numbers in the Kelly's equation, and it'll give you an idea of how efficient your portfolio strategy is at that moment in time. Now, it's not perfect, right? Because it's assuming that you have a uniform portfolio strategy, which you don't, most likely, but hey, something's better than nothing. Rule number 3, spread out your risk and analyze past performance. Adjust the size of your investments respective to their levels of volatility and risk. We talked about in video number 1 how to determine what kind of investor you are. So based on that, you generally want to put more money into less risky investments and less money into more risky investments, but that's not always the case. If you're a highly risky investor, you do just the opposite. You're going to put more money into high risk investments and less money into low risk investments, because you're kind of gambling on the fact that you're going to make a ton of money, because the higher risk you take, the higher your potential returns are, but the lower odds that you have to actually make those and realize those returns. So keep that in mind. You need to regularly review your portfolio and rebalance positions as necessary to just make sure that you try to avoid having disproportionately overexposed yourself to one particular crypto over another. Now, some people don't mind doing that, so don't let me tell you that that's what you should do. It's just you're taking on even more risk by holding an outsized position. And go back and look at the past performance of previous iterations of your investment portfolio. Learn from what's worked and what has not worked. The more studying you do, the more you're going to learn, and the better an investor you'll likely be. So in summary, proper portfolio risk management is about balancing reality with your expectations. If you're a technically savvy person and you have a background in computer science, you can implement some of the statistical methods that I outlined in this presentation, and I'm going to put links in the video description. Remember, all investments come with risk. No strategy, doesn't matter how comprehensive it is, can save you from the implicit risk of putting money in the crypto markets. So you need to be flexible and adaptable with your investment strategies and be willing to pivot as needed. So, just to remind you, my next risk management video will be on understanding market psychology. The one after that is on using risk metrics, and the one after that is on profit taking and market exit strategies. So please be sure to like, comment, subscribe, follow, all that great stuff. Click the notification bell to be notified when I release another one of these videos in the near future. Thank you so much for joining me. And you know what? Thank yourself for taking time to get educated about how to become a better investor and manage your risk management so that you can ensure that you are maximizing your probability of profitability while minimizing your downside risk. Please be sure to join our free Telegram group at the Snake Pit. And if you follow me on Telegram, you're going to get exclusive free access to my portfolio management tool. And that is available only for a limited time, this month only, which is the month of March. Hop in there and I will announce that in my Telegram alerts channel at some point. And if you're in there, you will have access to it. So that's all I got for today. Thank you so much for stopping by the crypto simulation. hope that you have a great day, great night, great afternoon, wherever you are. You make some money. Nothing in here was financial advice. Any gains that you make in this market are because of you and you only. They have nothing directly to do with me. Wishing you all the best. Take care. Bye.